Today we are expanding the topic which we discussed last week. Last week we had a webinar on how to replicate a cash market investment through options so that you invest less. So the entire idea was you invest less amount, probably 1/4 or 1/5 of what probably you will invest in a cash market, but get the same result of a cash market portfolio. So this we highlighted with the help of one example, but we said no, we will look at the illustrations in coming webinars. So we just wanted to highlight the fact that if you want to invest a limited quantity, let us say in cash market, if you want to invest 20 shares of Nifty, then 20 shares of Nifty today will cost you around 3 lakhs, right? So that is 15,000 into 20 is 3 lakhs. But instead of 3 lakhs for 50,000 or 60,000 rupees, you can invest instead of 3 lakhs, but get the same result of the same 20 shares of investment of 3 lakhs. This is what we said last time. And you said the result, so that will enhance your yield. Now we will look at the illustration in coming probably next on Friday. Today we are going to look at 2-3 important things. One is how to replicate futures with options. Now instead of cash market, how to replicate. That means, let us say in the case of futures, what is the margin, and whether through an option, whether we can get a result which is very similar to the futures, but invest quite less when compared to the investment that you do in futures. Then second thing is we will try to understand delta with the help of option price itself, because last week somebody was asking where do you know from which side you look at the delta. Now that particular thing we explained with the help of one website, optionprice.com. There are many such sites where you can look at it. So we will just look at what is delta and also how to look at the delta from the option price itself. Then the margin. So I think probably what we will do is we will first look at this margin, look at how to replicate the futures with options. Then we will look at how to look at delta from the option NSE option chain itself. So we will look first at the margining. Now, if you want to invest in futures, today the margin could be something like 1.8 to 2 lakhs, right? So I think probably very closer to this, somewhere around this, I think closer to this. Plus you will have the MTM, right? So one contract of futures today may entail you approximately 10-15,000 rupees either way, may not cross 2, but it could be 1.7 or so, around 0.8. So somewhere around closer to this particular investment, right? So one futures in Nifty today will make you around this, so which means that probably we have to put in more than 10% margin, because one contract investment today is around 11 lakhs, because 15,000 into 75. Now, so you need something like definitely a 10% margin which is required for that. 15% margin may be required. So 15% margin will take you closer to the 1.7 to 2 lakhs there. Now, how do we look at the spread trade in order to ensure that we invest quite less than this amount and get a same result, almost the same result? Now we have already highlighted to you that is options. Probably we are not going into the details of a call option and all, because we have had many such webinars before. But just for understanding, to recap, if you want to buy a futures and the same thing you want to do in option, now you just buy a call option, right? So you buy a call option which will be like something like a future. I'm not going exactly into the differences between a call option and futures, okay, for which we have had many webinars. I'm just trying to highlight that a deep in the money option of a call option is something very, very similar to a futures. So deep in the money option means, suppose if the market is trading at 15,000, you get 14 in this coming week, 14,700, 14,500. They are all deep in the money, okay. So which will be something very closer to the futures payoff. So you go into that particular sort of an investment. That is, you options, use the option for doing such a futures trade. Now, one is that the disadvantage of an option also we have already highlighted, that there is a time decay. There is a probability of a volatility. So what are the disadvantages of an option which we want to neutralize is the volatility, one, and second thing is time decay. Volatility can be an advantage or a disadvantage, but in case if there's a decay in the volatility, in the implied volatility, if there is a fall in implied volatility, if you buy an option, then that will erode your option value which you have already bought. Time decay will anyway work against you. Okay, so these are two things which time decay will definitely work against you. Volatility may work against you. Okay, sometimes it can be favorable. So what we want to do is that we don't want these two things to hurt us. I mean, like we simply don't want to take a headache on whether volatility go up or not, and we want to neutralize this time decay. So we don't not bother about it. We simply want a very clear thing, that is, our investment alone should be lower than the futures, give us the return which is equal to the futures. Okay, so this is the simple equation. So in that particular case, we need to understand first of all the margining in the option trade in the case of a spread option, so that we will see whether that particular margin that you have to put in is lower than this futures. Okay, so now the margining system in present margining system in option trade is like this. If you buy an option, then you just pay a premium, right? So any spread trade will have a buy option and a sell option. So when we say spread itself, it has to be more than one leg. Okay, so one is you are buying an option. Second leg is that you are selling an option. Now, so if you just buy an option, only if you just forget about selling option, you just buy an option, you just pay the premium, right? You just pay the premium. If you only do a sell option, you need to put in a margin which is almost similar to a futures, right? So if you only do a buy option, you pay the premium. If you only do a sell option, you just pay the futures margin, almost closer to the futures margin. Now we are doing a combination, buy option and sell option, which means it is an edged trade, right? So you are live. Suppose let us say you are buying an option which is 14,700. and you are selling an option which is 15,000, let us say call option. Okay, so this is what is called as an edged trade, because the sell option has been edged by a buy option. So there is no risk, because if the market goes up, you have already got a buy option with you. So absolutely you don't need to worry about it. So a sell option will not hurt you in case if the market goes up, because you have a buy option whose strike is lower than the sell option. So this is called as an edged trade. If the market goes down, then the question is the loss will be on the net premium that you have paid. That is, the net premium that you have paid will only be the loss in that. Taking into account that there is a loss which is going to be there only on the buy option minus sell option premium. That should be the only amount that should have been collected. But what the NSE does is, the margining system, it first before we go to that, see, in the case of margin collection, there is what we call as a span margin and exposure margin. So these are the two margins which are collected. Okay, in the case of futures, span will be there, exposure will be there. Okay, now span will be the most consuming. That is, as far as investment is concerned, the span will be a considerable amount. Then exposure is there. Nowadays, both the margins have to be collected. Now, the exposure margin in the case of index is now 2% of the contract value. 2% of contract value. So, if the contract is around 11,000, so 2% of that is around 22,000. So, approximately 22,000 is the exposure margin. So, if it is an edged trade like what we showed, that if you are buying a call option and then selling a call option at a higher level, at a higher strike, then in that case there is no span. This span is not there. So, in the case of a spread trade, which they call as an edged trade, like the one which I illustrated to you, you have no span, but you have to pay an exposure margin. So this will be your investment. Plus what they do is, they should have collected only the net premium amount. See, in the case of a buy option, you pay a premium, right? Let us say buy option premium, you pay 200 rupees. Illustration, we will look at the actual illustration now. And in the case of a sell option, let us say it is 50 rupees. Okay. So what they should have collected? They should have collected 150 rupees into 75. So maybe 10k plus, okay, approximately. This should have been the premium collected by them. But they don't collect the net. They instead collect this month. So that means this is an additional investment that probably you are putting in. So what they do is, they ask you to pay the buy side premium fully. Buy side premium has to be paid fully. So in this case, if buy premium is 200 rupees, so you pay 200 into 75, which is 15k. Then we have seen the exposure margin, which is 22k. So you need to put 37k as the margin. you need to put 37K as the margin. So what they do is they don't collect only the net amount, they collect the full buy amount, because of course the net amount is going to be the actual loss, so they need not have been collected. But as an overall part of an adjustment strategy, they ensure that the buy amount of premia is collected fully, okay, because that is going to be the maximum loss in case if the market goes down. Okay, the maximum loss should be only the spread. But why they collect it is that in case if you remove only the buy side, so the sell side will be there, and so sell side will then immediately attract the margin. So in order to ensure that the buy side loss is fully first covered, they collect this buy side premium. So what you have to do is that simply very clearly, if you want to do a spread trade, what you have to just do is buy side whatever premium, that amount plus 2% of the contract value. Simple. So this is what your investment will be. Now, having understood this, let us look at the how to replicate a futures trade with the help of an option. Okay. Now we have seen. We will just go straight away to the quotes in order to understand this. Okay. So what we have said is that why we want to do the spread trade. We have already highlighted. Basically, in order to ensure that our investment is less, then the volatility is neutralized, because we don't want to take a call on the volatility. At the same time, we don't want to suffer from the volatility decay. Okay, volatility decay. Okay, so these are basically the reasons why we want to do a spread trade. There are different ways that probably you can look at the spread trade. This one, but our intention is to lower the investment. So if there are depending on your objective, this is the first objective. Probably there can be some other objectives for which we'll come to it subsequently right now. So the first most important thing that we will now look at is how to reduce, how to ensure that we go with the futures, but we want less investment compared to the futures. So let us look at the coming week. First of all, we will look at the next 3 days, right, till Thursday. So what we did is that right now it's around 14,925 or so today it closed. So we will look at 14,500 option and 15,400 option or 15,300 option or whatever it is. Okay. So let us look at what these 2 option prices are and construct a spread trade and look at the margin that we may have to pay. Okay. So we go to the NSE website. So this is in white background, so I will just explain to you the price. This is an NSE option chain. So if you go there, you will definitely put NSE option chain in Google, you will get this, and here you can just put the date, right? 18th March. Okay. Now let us look at the trades which we thought of right now. So 14,000, we are looking at the call option, right? So okay. So 14,000, let us say 14,500 call option. Right now it's going at 449. Okay. So 14,500 call option for 449. 449 is the price for 14,500 call. And where is the trade right now? This is 14,925. So 14,500 plus 449, it makes you 14,949 or so, right? Maybe 24-25 rupees. That's on a close basis I'm saying, but around 24-25 rupees, approximately, or 20 rupees is the time decay that you are paying, because right now the futures, let us say this is a spot value 14,925. Futures value is slightly more, even for 2-3 days it will be slightly more. Okay, so 14,949 approximately at 24 rupees. I'm talking about from the spot side, but it could be around 20 rupees from the futures side. So is a 20 rupees time decay approximately is what probably we are looking at working against us. So how do we neutralize that? Okay, so we go back to this one. So let us look at the one which is around the 24-25 rupees. Or approximately so that we don't get completely disturbed by. So now 14,925 is 400 rupees on this side, right? So 400 rupees. Similarly, let us look at 400 rupees from the present price, which is something like 15,300. If you look at it as 15,300, Recent high is around 15,300, right? So the recent high is something closer to 15,300. So the price is around 25. So we'll look at that same thing. So 15,300. Okay, so you have 25 rupees here. So you have 25 rupees. So what's happening is we are paying 449 and we are collecting 25 rupees. So 440, let us say 450 minus 25, it becomes 425. 425 you add to 14,500, it becomes 14,925, which is where the present price is. So we are not having any time decay problem. So when you have no time decay problem, both being on the equal side, one on the buy side and on the sell side, volatility will almost get neutralized. So our problem of time decay and volatility has been completely addressed. Now let us look at what is the margin amount that we are going to have. Now that means this becomes like a futures, right? So this has become like a futures. Why I will tell you this futures. Now 425 rupees is what the premium you are paying, right? So now 14,500 is the strike price which you have taken. Let us say by end of this period, in the say by 18th, the market slides down to 14,600. 14,600. So if you have invested today in futures price, what would have been 14,925 minus 14,600, you would have lost 325 rupees. You would have lost 325 rupees. Now the same thing, you have paid 425 rupees, right? Now you have paid total 425. If it closed at 14,600, you have taken the buy strike at 14,500. So you will realize 100 rupees for that. This will become worthless. So the net difference is 100 rupees you got because you are 100 rupees higher than the strike, but you paid a premium of 425. So the net premium that you have paid, that premium that you would have paid for this trade would have been 325, which is the loss in the case of the futures trade. But if the market is to slide below 14,500, then you have got a benefit, because in the case of futures, you will continue to make a loss. You will continue to make a loss below 14,500, but whereas here the maximum loss is at least stopped at 425. But there the chances of your loss being below 425, above 425 is there, because anyway you have bought only a spread trade. So in case of a devastating fall, this will save you compared to the futures, even compared to the futures, because the difference is still limited to the extent of premium paid, which is 425. The loss is still limited to the extent of 425. But whereas in the case of a futures, the loss will be even more in case if it starts sliding below 14,500 and you have not taken any action. Similarly, it also applies that in case the market goes above 15,300, but we will come to that later on, because you can always roll over the option by slightly getting ourselves by rolling over the option of one strike for every 100 rupees or 200 rupees, you can move it slightly higher and get a benefit. So it's almost the benefit will be very closer to the futures price. Now exactly ideally I'm not talking about, because chances that market within 3-4 days, okay, within 3-4 days, in rare circumstances can go above 400 rupees from this point, because on a week-to-week basis itself, it's only 2%, 2.5%. It's a normal game, okay. So in normal circumstances, we don't expect within 3 days market being 400 points above. But we have seen even last week, it was close to 15. It started somewhere around even on Friday. I think Friday the morning market was 15,300 or so. Today it was 14,650 or so. So in 2 days, whenever the fall takes place, such a fall can always take place. Similarly, the rise can also be there. But generally speaking, getting above 400 points to close above 400 points in the next 3 days, it's a little less of a chance. We will go with that. Okay. So, but if it happens also, we will know how to just roll over the option, for which we will come to it in subsequent class. So for the time being, you please accept that the market will be between 14,500 and 15,300. Now, what is the premium that you are paying? Net premium you leave it. From the margining point of view, you will pay the buy side premium, which is 449, or let us say 450 rupees. So 450 into 75. Okay. So 450 into 75. That is 33,750 plus exposure margin, which is 22,500, let us say. So 33,750 plus 22,500, 56,250. Okay. So this is the amount that you will be investing, which is similar to the what I would say futures, which could be very similar to the futures. Sorry, which is very which will give a result which is similar to futures. But let us look at the investment. There you would have invested something like 1.8 to 2 lakhs. You would have invested 1.8 to 2 lakhs. This is 56,250. So you have brought it down to, you have reduced 2/3 of the amount that is required for investment. So you are investing only 1/3. You are investing only 1/3 of what you would have invested for in the case of a futures. So whenever the return comes, you will have a much higher return on investment even when compared to the futures. So you will have a fantastic return in case if you make profits. Okay. So we are now able to show that 3 parameters, the objective which was laid down initially, that let's get out of the time decay. I don't want to take the headache of a time decay in the case of buying of an option. That has been neutralized through a spread trade. Second thing, volatility has been neutralized. Third thing is, I want to invest less compared to the futures investment. That also has been met. So don't you feel that this is more advantageous when compared? And also, if the market is to slide below 14,500, this will be better than futures. It will be slightly worse than futures if the market is good above 15,300, for which probability could be less now. But in case if it comes, we will just roll over the option, slightly put it on the higher side, because if it's going to take above 15,200 or so, then in that case what we can do is that we can remove, we can just make this instead of 14.7 and we just put it 14.7 and 14.5 and 15, right? So 14.5 and 15,300, which we can make it as 14.7 and 15.5. So we can just keep moving that a little higher in case we get we break some important levels. So this is able to reduce your margin even when compared to the existing in normal futures, right? So a very clearly a favored trade that you can go for it. Now, if you want to look at this particular month, you can look at it. Probably you want to look at some other month, you can look at some other month also. So let us look at what some other month or some other day. Okay. So let us, instead of 18, you can also do it for 25th. Okay. So 25th, if you want, you go to the same energy option chain, and but only thing is, why I have chosen the near period is that you tend to pay much lower when compared to the investment in the futures, because if you are going to go for a slightly larger time frame, then in the, or a date which is beyond the present week, that the investment will be more. So the result will be the same, but the investment can be more. So let us look at the investment. Now suppose if I say go for the same 14,500 for a 25th, then I may have to let us say instead of 18, I will make it as 25th now. See, 25th, if I make the same 15,500, it will come to 537, slightly more. So 537. So the 537. So there's a time decay of 90 rupees that I am paying here. So I'll have to look at something which is which gives me the same 90 rupees out. So then I'll have to do the same 15,300. There also I'll have to do the same in order to ensure that I get the same effect of a neutralizing time decay and volatility. Then I will have to do a 15.3. But for 25th, 15.3 is a real possibility. So it may call for more amount of rolling over of the option or something like that. Okay. So I will find it a little difficult. Then in that case I will have to do something which is slightly higher period, which maybe I will have to do a 15.6 or 15.6 or 15.8. If I had to do a 15.6 or 15.8 where I am paying 16 rupees to get the time decay, then I will have to go something closer to 14,000. 14,000 means it's going to be 975 rupees, 1,000, so 75 plus 22.9. Still it will be one half of, still it will be half of the futures. So if I don't want to do a little more frequent trades in this, then I will have to choose 14,000. Here is 972. 14,000, and that side I will sell 16,000. So I would have definitely neutralized time effect to a very large extent. and so the 14,000 calls for 975 rupees. So that is calling for 975 rupees. So if I do a 14K and 16K for 25th, then I will have to pay something like 975 rupees here. Okay, so 975 into 75 plus 22,500. This is the margin I'll have to pay. So 975 into 75, 73,125 plus so 95K I'll have to pay. Still it will be 50% of futures, but there it is only 1/3, right? So 1/3. So even much lower investment will be called for in case if you go for a probably the weak strike. So you can go even for a much lower investment. Now if you don't want even pay the exposure margin 22,500 you don't want to pay, then in that case you have to take what in this particular case we have seen, you just need to take 975 into 75, which is 72,000 72,000. There will be some small time decay because you are paying 14,000 plus 975 plus 14,975, and present futures is maybe 14,950 or 960. Some 20-25 rupees extra maybe have to be paid. But I think probably you can take that call and pay that extra 20-25 rupees only. So you can just go for a 73,000 rupees investment alone. So by going in for deep in the money option, or going for a spread trade. So here also the time decay is not much, volatility effect on a deep in the money will not be much. So you can go for a straight away deep in the money, or you can go for a spread trade. And the spread trade will call you for extra 22,500 in order to ensure that you don't have problem even with that small volatility price range difference, or probably with something like a time decay even for the extra 20-25 rupees, because 20-25 rupees of savings on a 75 is 1,500. 1,500 investment of 22,500 will pay you, because 1,500 and 22,500 is something like 6 to 7% per month. So good money. So it is better that you just invest the 22,500 rupees, and instead of doing this you go for only a weekly option. So you pay only 56,500 by doing a 14,500 and 15,300 spread option. So a very clear case that where the futures margin. So whenever you do a trading, you have to think from different angles. One, of course, is a trading plan, clear plan as when the entry should be made, when the exit should be made. But along with that, particularly if you are an investor, okay, and you want to ensure that you get a higher return with a lower investment, then in that case you have to call about for a money management. And the for the money management, you have to think about how do I reduce my investment, but get the same return. So that is a very key point. That is, instead of you looking at all these technicals and other things, probably at various points of time it can frustrate you. Because today, if you see, let's look at the market today. It was opened. It was close to 15,000 at one stage. Okay, then suddenly it fell, and then it fell closer to 14,000. I think 740 or so. Okay. From 740 it has rose to 14,940. So look at the swing, 300 plus 200, 500 points. And in fact, today it broke some important low also, which is a stop loss level, 14,825 or something was there. And it broke below that 14,825, just skidded by 70-80 points, and then rose very significantly within just between 230 and 330, the market was robust from 14.8 to 14,950, 150 points. So in these places, you need to be very careful, because stop loss sometimes will hurt you too much, because today even on a smaller time frame, if you want to put in a stop loss, it's around 150 to 200 points. Even if you're going in a 5-minute scale, today that is the extent of your swing that is taking place. So in that case, you need to clearly think about what is your plan. That is, whether you want to be a trader in this market, or you whether want to be an investor in this market. So where the problem comes with, as far as the technical is concerned, in that case you need to really go with some sort of an investment orientation, and that investment orientation should come with rationalization of the thing. Because what is it that you're going to now tell me? If you can just say that why are you doing trading instead of investment? The reason you are doing trading out of investment is to get a higher return, which you think you will be able to get by doing a trading rather than doing an investment. That is the reason which why you are attracted to it, because you want to put less money but earn more. Okay, so that is the reason why you are coming for trading. But just think about the same thing as far as you can do it with the investment by putting a lower capital. Now, if I say that the futures investment has given you 10% per year, the same thing, instead of full amount, if you put a 1/3 of the amount, the same futures instead of 10% would have given a 30% return. So you should think about from those angles where the investment return is quite high. By investing at various levels, and also by going for a investment which is lower than what you're putting in the cash market or the futures market. Okay, so that can attract even persons. No, if you understand this option type of structures and the margining, then even people who have got some smaller amount can still come and probably participate in the market, but of course very carefully after knowing the market of its pitfalls and rise and other things. So this understanding the margining, understanding the spread trade, what are the difficulties in buying an option, what is it can be neutralized, same time why we should not go for a blind sell, particularly when you are a new entrant. So these things have to be thought of, and you have to put in such a thing. Now there are various other alternatives also. Now this is one clear objective that we have mentioned to you. There are different proposals. There are different ways of looking. Which other option that you can look at it. But if you want a clear side of if the entire intention, if the entire objective and intention is only to ensure that you go for a lower investment, this will appeal. Now, if you have another intention that I don't mind putting in the same amount of futures money, but I want to get a benefit which is slightly better than the futures, there are also other alternatives are there. So, in the case of options, you can just decide about how exactly that you would like to do the trade. Now, I will explain through with the help of a delta in the next class on next session on Friday. Now, for the time being, we will look at how to look at the delta, because that day we just said that delta you can look from the option price itself, from some calculators. Now, let us look at the option price and try to understand, so that you don't need to get. Now, what is a delta? First of all, the delta is nothing but the probability of a move. Now, if you are at 14,900, then it is an equal chance tomorrow or on next week or whatever it is for the market to go from 49 to some higher level, or from 49 to lower level. It's almost an equal chance. It's almost an equal chance for if you look at a considerable period of time, because it is like a toss being tossed. In a cricket match you toss it. So in 5 games or so, probably you can even win 5 heads if you call it. But if you are playing 100 matches, if a captain is to toss it for 100 matches, or let us say somebody tosses for even more number of matches, the chances it could be 50-50, because you cannot win in the same proportion of 5 out of 5 in case 100%. Nobody is going to win the toss 100 times in 100 circumstances. Winning 100 tosses is not going to happen. So there will always be a probability which will be almost equal for a fairly large number of months. So if you are talking about the market, whether it will go up 1 year later on or down, it will be 50-50. But we may know from the statistics that it may not be 50-50, it could be 80-90 or 90-10, because we have seen that statistically that in the last 10 years, December to December, if you compare, then 8 out of 10 times the market has closed on the higher side. So we can always say it's an 80% probability for us. Okay, but that is based on what we have seen over a period of 10 years. Suppose we don't have a result for 50 years and 100 years, because the market might not have been there. But for suppose if you take on a month basis, suppose or a day basis. Now let us say today. Now let us look at the last 1,000 days. Let us say 1,000 days is the only 3, 4, 5 years. If you look at the last number of 1,000 days, how many times the market compared to yesterday would have gone today higher or lower? It will be almost 50-50, or it could be 55-45. So 55-45. So over a large period of data, this will be an equal chance, almost an equal chance. But within a small number of data, it could be there. For example, if you do 10 years, it's like 10 tosses. So 8-10, 8-2 combination will be there. But if you look at the number of days, so if it is 1,000 days, then chances that over a period of 1,000 days, it has to be 50-50. Okay. So that is similarly, the delta will give you that probability, okay, of how the market can be on a large number of data. What is the probability? It can be higher or lower. Now from 14,900 to 15,000 or 14,900 to 14,800 going down or up tomorrow when compared to today, or in a week or a month, is going to be 50-50. Now let us look at this from the angle or from the option price, and this is for let us say we have done it for 25th March. Now the price right now is closer to 14,950 or so, right? So very closer to 14,950. Now you want to know what is the delta of 15,000 for 25th March, because every time when you look at the delta, it has to come with the time period also. So you are now asking for the 25th of March, okay, what is the delta of 15,000 call? Now 15,000 call, if you look at it, is around 205. So let us look at 15,100 call, because when we say about delta is nothing but change in option. So if mathematically it's nothing but a change in option price divided by the asset price movement. Suppose if 100 rupees, if Nifty is going to move by 100 rupees, what is going to be the change in the call option price from 15,000 to 15,100 tomorrow? Suppose if market is going to rally by 100 points tomorrow, what is it that probably the 15,000 will become 15,100? So what does it tell us today? Tomorrow, because if the volatility is not higher or lower, probably there could be some difference. But today, speaking at it, what is the 15,000 to 15,100, right? So if it is going to move 100 rupees tomorrow, what is it that the change in price is going to happen, right? So now the 15,000 call, okay, if it is going to happen, 100 rupees up from this particular price. So let us say from 14,950, it is going to move to, let us say 100 rupees it is going to move. So in that particular case, you can just see 230, right now 14,950 is 230, 15,050 is 180, right? So exactly 50, that is, if 100 rupees is going to move up tomorrow, there's 14,950 thing, that is, sorry. Okay. Okay. So 14,000. We are speaking at 14,000, right? So 205. This is 158. This is 158, right? So what is the difference that is going to come for 205 to 158? It is going to be 47 rupees. So we can look at it. 205 minus 158 is going to be 47 rupees. So a 15,000 call delta, because of the change in the price that is going to take place, this price 205 and this is 158. So 15,100 call itself will become 205. Suppose if it is going to move by 100 rupees or so, then in that case, what is the change that can happen as far as this particular delta is concerned? So that is what we are going to look at it. Now, for example, let us say 14.8. Now 14.8 call is now going at 320 rupees. So 320 rupees. Tomorrow it is going to move by 100 rupees. Then this 14.8 call will behave like a 14.700 call of today, right? See, today 14.800 call is 320. If the price is going to move by 100 rupees from 14,950 to 15,050, what will happen to this call? What will happen to this 14,800 call? This will become like a 14,700 call. This will become like a 14,700 call, right? So in that case, what is the difference? It is 66 rupees. It is 66 rupees. So the 14,800 call, you can just say if for an 100 rupees movement, if this is going to become like a 14,700, then the delta of a 14,800 call is 66. You can say it's around 66 is 14,800 call is going to be 66 is a delta. So that is why you just look at one price, which is if the market now, let us say it is around 14,950 or so. So the 15,000 call will become like a 14,800 call, right? So today, let us say what is the futures price? We'll look at the futures price today. So index closed at 14,929 and the futures price must have been 14,950, because that is what the calculation, because it is exactly at the money. it shows the same price, so 15,950 or 15,956. Okay, so the 15,950 right now, okay, will move by now this 230 rupees is there, and the next price is 180. So what is going to be the change in this price? It is 230 to 180. So this is going to be 50 rupees. So anything which is above this particular price of futures, you look at the next price which is above. So 230 to 180 is 50 rupees. So that means 15,950 call is the delta is 50. Now 15,000 to 15,100 is 205 to 158, which means the delta is 47. Now 15,100, 158 to 120, that means the delta is 38. So the delta is 38. That means if the you can just look at it like this also. If the market is going to slide down, then the question of the 15,100 call tomorrow will become like a 15,200 call. So the delta there is around 38. So whichever way that is, if it is going to be deep in the money option, you look at 14.8. If it is going to be 100 rupees higher, then in that case it will be like a 14.7. Whatever the price of 14.7 today is, that will be the price of 14.8 tomorrow if the market is going to go up by 100 rupees. So you assign a delta of 66 here. Suppose if it is going to be on here, it is 15,100 is going to move to 15,000. If the price is to slide down, then for those strikes which are above the at the money, for those strikes which are above at the money, you calculate like this. If 15,100 is if the price is going to slide by 100 rupees, then this 15.1 will become like a 15.2. So that will become 38. So the delta there is 38. So this way you don't need to really go to an option calculator. Plus or minus some, I think if I am saying 66, it could be 65, 69 like that. So almost a very closer thing. So you don't need to strain yourself even to go to the calculator to find out. So very clearly that with the help of the option price itself, you can find out. Now let us look at the 18th delta. See now, let us say 14.8. 14.8 is 206. Okay. Now 14.7 is 279. So the delta of 14.8 is going to be 73, because tomorrow it is going to be by if the asset prices move by 100 rupees, then the good chance that this 206 can become 279 tomorrow. 206 can become 279 tomorrow. So the delta of this could be something like 73 rupees. And probably, because of some time decay, maybe, if there is not much of a price difference, then of course it becomes static. I am only talking about if the price moves up by 100 rupees or so. Okay. This delta will be now for 14.7 delta is going to become 14.8 delta is 73. Now tomorrow, if the price does not move by 100 and it moves only by 50 rupees, then in that case 50 into 0.75 should become 35 rupees also. So that may not happen because of the time decay. Right? But today, what is the delta? The delta is this one, 73 or 75, based on one option price and the next strike option price. What is the difference in that? For an 100 rupees difference. So here it's an 100 rupees difference you are looking at. What is the change in the option price for that 100 rupees difference? Then that becomes the delta for that particular strike. So that is how you keep looking at this delta easily, compared to going even with the help of the calculators. So today we explained to you how you can reduce your investment in futures with the help of an option trade. How to know about the margin. Very clearly 2% exposure margin plus a buy side premium for a margin trade. Third is that how do you look at what is delta, and how do you look at the delta just from the option price. So this is what we have wanted to tell you today in today's webinar. Hope we have been able to give you some information on that. Now time is 7:45, so you can ask your questions. Come on Friday, I think we will look at some illustrations, some other objectives. Now today we had one objective. Maybe on Friday we will have some other objective. Maybe in the future, maybe the investment may be higher, maybe equivalent to even futures, but the result can be better than futures. So you can have it like that also, right? So let's look at that on Friday also. We'll look at it. Okay. So now you can ask your questions. Thank you very much. So this is a slightly advanced topic, no doubt about it. But since we have already explained a lot of basics over the last 3 years, we thought probably it's time for us to go to the next level. So those who want to really go into these all things in topic, I think you have to experiment, experience, and do that. No, there is no minus 2. The delta is always plus 1 or minus 1. So there is no minus 2 delta. Okay. Minus 2 delta means then in that case you will have to have more than one contract. So in one single contract the delta will be plus 1 or minus 1. When you say plus 1 or minus 1, it is like a futures. If you say plus 1, then it is like a futures. Okay. If it is minus 1, it is a sell futures. That's all. So if you have two contracts of selling, then it becomes a delta of minus 2. Because let us say one contract. Okay, one contract, if it is a futures, if you have the sell contract, okay, then in that case it will become a delta of minus 1. If you have got two contracts, you can say it is minus 2. So I am holding a delta of minus 2 means what? I am holding two short futures, that's all. Okay, if you are saying I have a contract of minus 2 delta, means a futures alone will have a perfect plus 1 delta or minus 1 delta. So futures will have, if you are long, plus 1. Okay, it is minus 1 if you are short. So if you are saying minus 2 delta means, that means 2 contracts short. That's all. Okay. So if you have 10 contracts short, then you have minus 10 delta. Okay. Now the number of units is 75, right? So you can always say it is minus 750 also, because 75 units is there, right? So you can say minus 750 also. Okay, thanks for your participation and hope to see you on Friday with illustrations. So please join me on Friday. Thank you very much.